So this topic we're looking at is cash flows. Now, cash flows it's not about accrual accounting in this case. The first four topics are all about the whole accounting system, from recording entries in the journals and then moving through into the ledgers, into the trial balance and so on. The statement of cash flows is actually a little bit different. So before we jump in to have a look at it, okay, the learning objectives: describe the purpose and format of the statement of cash flows, describe the process of preparing the statement of cash flows, then 3 to 5 are preparing the operating activities, investing activities, and financing activities in certain methods. And then 6 is actually preparing the operating section in a different method. Now, so if you really break that down and look at those objectives, there's kind of 2 things that we need to talk about today. Firstly is, why do we have a statement of cash flows? And the second is, how do we make a statement of cash flows? So we're going to spend a bit of time in relation to the first section looking at what we have in front of us. And it's far easier to do this with a real situation and a real example rather than sort of talking around it. So the statement of cash flows reports the impact of a firm's operating, investing, and financing activities. What are these? We will find out. On cash flows during the accounting period. Some would say that the statement of cash flows is one of the most important of the 4 required financial statements, especially those involved with finance. If you're doing finance, they probably talk about cash is king and they just really focus on cash flows and just cash movements. Cash is important, and we're not saying it isn't. There is a big concern, and when we looked at over the last couple of weeks and Qantas and the changes that they made, and again, I'm not saying they did the wrong thing, but you can see how easy it is to change accounting numbers and get a completely different profit figure. It is possible to do that, and people do have concerns about what profit is. And there's this feeling that cash flows is something more real. You can't eat profits, whereas cash flows you can actually use in a real sense. Cash you can actually do something with. So yeah, there are people who say that cash flow is one of the most important of the 4 required financial statements. In saying that, there is a lot of good reason why profit is important. And this example that we've got on the board actually speaks to that. If we were purely looking at cash flows and we have this asset for 5 years, the only cash movement is in the start of year 1. Year 2, year 3, year 4, year 5, assuming there's no sale, there is no cash movement of us using this asset. It's just sitting there working away, doing its thing. Whereas with profit, yes, we've had to make some assumptions, and yes, they may or may not be good ones. But we've actually allocated some of that cost out over the life of the asset. So we can see that this impact of this asset, from a cost point of view, impacts over multiple periods rather than just the first one. So it makes sense, but there are problems with it. So cash flow is something that you should look at alongside profit. And I'm going to show you as we go through, I'm going to show you how that can be really useful. So again, I'll sort of deviate away from the slides to pick up on some of that. The statement of cash flows summarizes the company's inflows and outflows of cash over a period of time. Now that's a really interesting comment, because we actually know if you weren't given, this is from Woolworths, so you should actually, you should have a copy of this financial report, because this is what we asked you to go away and look at before the session started. I'm not saying you should have it here with you right now, but when you looked at Woolworths, if this statement wasn't in there, you would actually still know something. Because if you look at the balance sheet, you would have cash at the start of the year, which would be the balance at the end of last year. You'd have the cash at the start of the year and the cash balance at the end. And that cash balance at the start was $1.3 billion. The cash at the end was about, this is rounded off a bit. At the start of the year, they had $1.3 billion in cash. If you were to look at the balance sheet, you would see that number there. And if you looked at the balance sheet at the end of the year, they had $0.9 billion. Without a cash flow statement, you know that. It looks like you spent an extra $400 million has gone out of the business. And that tells us something. But what it doesn't tell us is it doesn't tell us what it's been spent on. And what that money has been spent on and that cash has been spent on could be wildly different, and what it could be different on can have very different impacts. Your cash could have gone down because you're having trouble selling to customers. So you've got an actual operational problem where you're not able to make money off the normal things that you do. Your costs might have gone up in terms of rent or profit, whatever it happens to be. It could be cash has gone down because you're repaying the bank money that you'd borrowed them from previously. It could be cash is going down because you're paying dividends to your shareholders. We don't know just looking at that. So what a cash flow statement does is it actually goes, let's look at all these movements and disaggregate them. So we get a better sense of what's going on. And as you see at the bottom, it categorizes these changes as operating, investing, or financing activities. Okay, so this is Woolworth's statement of cash flows. There are a couple of things to start off with. We've got operating activities, we've got investing activities, and we've got financing activities. So they've divided them up into three main sections. And that's good because those sections generally do slightly different things and they tell us something slightly different. Selling property and getting money from that is different from borrowing money from the bank, is different from generating cash from customers. Those are very different things. And so we want to know where this cash is coming from. So operating, investing, financing. At the bottom here, we're going to ignore the exchange rate differences. But what you can see is we've got these totals. So operating activities had a positive amount of $2.3 or $2.4 billion. Investing activities had a negative amount of $1.3 billion. So money went out because of investing activities. And financing activities had negative $1.5 billion. All up, $384 million, roughly that $400 million I was talking about, went out of the business. They have the start amount, which is what you'd see on the balance sheet, the 1.3 billion, and they have the end amount, which is what you'd see on the balance sheet. And if you went away and had a look at the balance sheet, you would see those exact numbers sitting there. So if in a way, if you want to think about this, what the cash flow statement does is it takes the cash balance at the end of the year and at the start of the year, and we have 956 and 1333. And it links them. It goes, we started with this amount. What are all the things which have changed? What are all the money that we've come in, gone out? What's all the things that have happened here to get us to this point? That's what it does. 133, 956. Yeah, so then what we want to have a look at is what do these three things tell us? So we'll start with operating. And again, it is in the slides in there, but it's easier actually to do it with this stuff in front of us. So what are the two big numbers you notice in operating activities? Yeah, receipts from customers and payments to suppliers. And if you actually cast your eye over the rest of all the inflows and outflows, those are the two biggest numbers by far. So what's happening here is that we can see that Woolworths has received over $65 billion in cash from customers that year and has given nearly $62 billion to their suppliers and to their employees. So to their people they buy their produce from, to their employees, to the various other sort of things that they do to run their business. And that's what you expect, because operating activities is just telling you what they do as a normal business. What you also see up there would be things like interest, and I'll talk about that in a moment, and tax. Tax makes sense because tax is just, you're in business, you're going to pay tax. So it makes sense that tax goes in operating. Interest is an interesting one because that wasn't meant to be a play on words. Anyway, interest is interesting to the extent that it doesn't have to be there. Because it could, you think about it, like it could be in investing. You have invested in, you might have invested in things. It could be dealing with, to invest in things, you've had to borrow money to invest in those things. It could be interest in relation to that. It could be, it probably sounds more likely that it should be in financing activities. The standards allow interest to be put wherever is most suitable. Now you could argue that interest costs, that could be working capital interest to help fund just the normal operations of the business. So Woolworths have made a call that that interest cost should be included within operating activities. And that's fine, like there's no problem with that. And that's a pretty common thing that you'll see. So for our point of view, you will see financing and sort of interest and tax payments in operating activities.
So financing causes interest.
Yeah, so financing would, we'll call it interest and financing. Just, we probably refer to it in our subject as interest. I'm just, when you see it, financing, so I'm trying to make that link between what we talk about it as and what you see here. In terms of the dollar amount that you'd like to see cash flow from operations positive, because that's saying the business is generating cash doing the thing which is meant to be doing. So that's good that it's positive. When we come down to investing activities, what we're interested in is non-current assets, buying and selling non-current assets. Now, there's a lot more detail in here than we are ever going to have to deal with in this subject. But if you look at it, property, plant and equipment sale, payments for property, plant and equipment, payments for property, plant and equipment, payments for intangibles, which are non-current, proceeds from sale of a business, so businesses would be non-current assets, payments for the purchase of business, payments for investments and so on. You got dividends received, but it's a pretty small amount there. What you're mainly dealing with investing activities is buying and selling non-current assets. And what we can see is the two biggest amounts are payments for property, plant and equipment, and payments for property, plant and equipment, and proceeds from the sale of property, so three biggest. They've spent nearly $2 billion on property, plant and equipment that year, $2 billion cash, and they have sold off about $700 million. And they've received cash for the sale of they've received over $700 million in cash for selling property, plant and equipment. So it's negative all up because they seem to be investing in things. Is that a good thing? Is that a bad thing? Just purely on the numbers that we see here, it's hard to tell. You need to look at what else they're doing. Strategically, what sort of things are they investing in? Does that make sense? Is it a good investment? Who knows? So that's a broader question that leads you down to. Obviously, if they're starting to sell off lots of things, which would be cash positive, why are they doing it? Are they selling off things because they aren't generating cash from other sources? Are they selling off physical assets because they're moving to a more online presence? Again, it's hard to tell. So those are bigger questions rather than just look at it and make a call on it just by looking at the cash flow statement. Financing activities. Debt and equity. Have you borrowed money? Are you repaying money? Are you issuing shares? Are you buying back shares? So it's just more so that's why it's financing activities. And if we look at the figure, look at what's here, proceeds from the issue of equities, transactions with non-controlling we don't need to worry about for here, proceeds from borrowings, repayment of borrowings. I should also add in dividends paid. So debt equity movements and payment of dividends happen down here. Dividends paid, and just a share plan movement, which nothing happens. So if we look at the figures here, there are three big ones. There is the biggest, which is, if I can line it up, dividends paid. So over $1 billion, or sort of $1.2 billion in cash was paid out to shareholders. They have repaid $1 billion, or just a touch under $1 billion in debt, and they've actually borrowed 600 odd million. So, you know, bit of movement going on there, but all up, that figure's negative, primarily driven by dividends. And that's the information that we have. So now that you read this, and you can see why this is such a useful statement, because that actually gives you a really good sense of what the business is doing, where it generates its cash from, and what it spends its cash on. Now, before we get into the details of, well, actually, before we move on, because I want to show you something which I think is quite interesting, and it relates to how we use this information. Do you guys have, now that we've had a look at this, are there questions that you guys have? Are there anything that's sort of springing to mind, or sort of any burning questions about how it's presented, what information is up here? And so it's going, get on with it. Cool, we'll keep moving. One comment I will make is this method for the operating activities section, these methods always get done the same. This method for the operating activities is called the direct method. And we'll talk more about what that means in a moment. So that's not the only way you can present that information. There is another way you can do it. So this method we see here is the direct method. If you flip over your page, and this is in note 22, this is the indirect method. And if you look at the indirect method, I want you to look at this very bottom figure right here, 2357.5. That is the same number as you saw on the other page. So it's the same end point that we get to, it's just a completely different way of doing it. Now, what you'll notice here is that there's no big, like $60 million coming in, 60 billion coming in, or 60 billion going out. If you look at it, it's not really happening. What this method is not starting from zero. It's not going, okay, how much money do you guys actually give me? What we're starting with is a different starting point. And the starting point is net profit after tax. So rather than look at, okay, well, you guys gave me $60 billion, that's $60 billion in, and then I paid money out. What the indirect method is going, what was our profit figure? And we know there are going to be non-cash effects in profit, and then just adjusting it. And we won't go through all the adjustments here and now, and I know there's some stuff later in the slides, but because the indirect method is not used by many companies in Australia. The preferred method from the regulators and from investors and users is the direct method. I did some work on this, something like 95% of Australian companies use the direct method as a primary method, so this is not a common one. They all have to show this in the notes, but you start at profit and then you basically adjust for non-cash movements. And a big non-cash expense is depreciation. So you can see we're adding depreciation back in. And then we add in a whole bunch of other things, and then we adjust for all these various other changes. But the big thing, and it is worth having a look at what those changes are and how you get to them, but the takeaway just for now is you're going from profit to cash flow from operations. That's what it's doing. But in terms of usability, and we've lost the, oh no, we haven't. In terms of usability, and we're going to go back to, that's not the one. What I actually want to share with you is, okay, this is a database which is available through the library. And I would highly, if you're doing finance, if you're needing to get company information about anything, I would highly recommend it. It's called DAT Analysis. I'll include a link to it, or just a reference to the name in the announcement tomorrow, but it's useful to have a look at. So if we look up Woolworths, okay, what we can get is financial data over an extended period of time. And what I want to do is pick up, I'm just going to copy and paste this stuff in because I want to show you something. Actually. If it works, there we go. Cancel. Okay, so what I've done is got the profit for the last 10 years. So that's what that line is. So that's profit for the last 10 years. And I'm going to pick up, it's worth, I'd highly recommend you having a look at this for whether it be Woolworths or another company. The cash flows from operations, I'll just get this. All right. Because I want to just show you what you should be looking for. Because if you have a look at it, apart from that final year, which has just happened, the blue line is profit, the red line is cash flow from operations. What you'll notice is they run pretty much in sync. And that's what you'd like to see happen. So in a way you go, well, profit, it's not telling it, or so cash flow is not telling us something that much different than profit. They actually do work fairly much in concert. That's what you'd like to see happen. If you were to run, apart from the last year, which brings, I think I did this before, the correlation coefficient up until excluding 2016 is about 0.8. They're pretty much completely correlated, which is nice. What you'd be worried about is if you've got profit doing this and cash flow, which is always going to be slightly higher, cash flow sort of keep in sync, and then cash flow from operations start to drop. Because what that difference is caused by is accounting effects, the big one being depreciation. So if you start to see a divergence starting to happen, especially with that cash flow dropping but profit going up, it looks like they are propping their profit up by using accounting adjustments and accounting sort of tricks, rather than sort of just letting sort of cash flows from the business. This isn't what's happening here. This is their profit actually looks bad. The cash flows actually have dropped a bit, but the cash flows aren't themselves from operations all that bad. But just to show you how big a driver depreciation is in all of this, I'm going to get profit and I'm going to add back depreciation and amortization. So this is now depreciation without just, this is profit. So now what we have is in the red is our accounting profit excluding depreciation and amortization, which are the two biggest things which affect non-cash expenses which affect profit, and we've got cash flows from operations. And with the exception of the final year, they almost match up perfectly. Depreciation, which is just pointing out that depreciation and amortization are the biggest effect which drives that difference. So from a usability point of view, how would you use this information and cash flow information? I would use it sitting alongside profit information. Don't use cash flow information in isolation. Don't use profit information in isolation. Look at them together. And look at them over an extended period of time. 1 year, 2 year snapshots aren't going to give you too much of a sense of what's going on. Look at it over an extended period of time and look to see if the pattern fits. And look, with Woolworths, they've had a big impairment. You can explain that profit effect because they had the disastrous thing with Masters and got rid of it. So that's actually talked about a lot of, so look again, I'll put some links up for that. what I want to have a look at now, and we don't need to necessarily do it separately for each section, is to look at how we can actually generate these numbers. And I'm going to actually diverge away a little bit from the numbers in the slides because, to be honest, I think we could do that slightly better. So just get rid of all this stuff. All right. So in order to explain a company's change in cash, you must explain the changes in the company's non-cash accounts. To do that, you need the comparative balance sheet position, so the start and end points, a statement of comprehensive income, or additional information on changes in account balances. What we are trying to do is problem solve. And it could be around operating cash flows, it could be about finance, it could be about investing. And I'll show you what I mean by this. Let's imagine we have cash, we have property, plant, and equipment, and we have equity. A really simple balance sheet. We have $100 in cash, we have $10 in $10 million, whatever it happens to be, and 110 in equity. So we've got assets and equity and liabilities is zero. Really simple balance sheet. This is the start. You know the end, so you'll have this information as well. At the end, you have 80 in cash, 30 in property, plant, and equipment, 110. Okay, assuming that is it, that is all the information that you have. That's a comparative statement of financial position. We don't have a comprehensive income statement. We haven't provided that information. And we don't have any additional information. Tell me what's happened. What is the most logical thing? Lots of things could have happened, but given the lack of information, what is the most reasonable thing that could have happened? We bought $20 a plant, and what was the consideration for it? What did we use? Yeah, so we bought $20 a plant, and go back to Mark. What did we use did we pay cash for it? That is like literally the only thing, the most logical thing based on what we see in front of us. Could that be the answer? Maybe not. Maybe a whole bunch of other things happen that we can't see. But the most logical answer is we bought PPE, paid $20 in cash. Because what we're trying to do is the cash flow statement is showing the link. And what you can see is if this has gone down by 20, other accounts overall must have gone up by 20. Everything else has to marry up somehow to what's going on here. So this has gone down by 20, this has gone up by 20. We paid $20 in cash, so we would have zero operating cash flows because there's nothing in there. We would have $20 negative investing cash flows because we've invested $20 in property, plant, and equipment, and we'd have zero financing cash flows. That is literally the only thing we can run off this, and that's what that's getting at. All that we would do for the whole process for everything else is actually the same thing, is just go, what do we know? How can we explain it? So if we were to do it if I was to add something in, I'm going to get you guys to think about this stuff as we go through. Okay, so now we've got the idea, let's just look at certain accounts in isolation. So we've got cash, accounts receivable, and then from the profit and loss, we have sales. So we know we've made, for example, 10,000 in sales. I think we actually have, so we've already talked about a lot of that. So we made 10,000 in sales. We have accounts receivable, which started at 60,000, and accounts receivable went up to 66,000. Say we have cash cash received of 19,000. So if we've got these sales, so this is information we know. We've got sales of 10,000. We've got an account receivable balance that has gone up by 6. So I've just made up some numbers to provide some context to it. So we started with $60,000 of people owing us money. We ended up with $66,000 of people owing us money. Cash has gone up from 15 to 19. So given this is the only information that's gone on, those sales, of these sales which have been made, if accounts receivable has gone up, we can't have collected off all of these. So if you think of what would happen, let's look at the account receivable balance in isolation. If we got account receivable, if we started with 60, we have sales of 10 would get added in here. We should have a balance of 70 if we collected off nobody. That would be the balance if we collected off nobody. But what we actually know is the balance ended up at 66. That plus that is known, that balance is known, so you'd have that information. We know that because we got told sales were 10. It's a matter of problem solving that out. We need a number over here to make this work. We need 4,000 over there. That 4,000 is a drop in accounts receivable. So we know that has to have happened. We know there must have been a credit to accounts receivable. So if we've got a credit to accounts receivable, what is a plausible debit? Cash. So if accounts receivable drop, they drop because we collect money from customers. But is that the only way accounts receivable can drop? Yeah. It could drop because of the allowance of bad debts. It could drop because we've written off some doubtful debts. Is there anything I've told you here about doubtful debts? So it could be an answer. It could be a plausible answer. But if we don't have information about it, you've got to assume that that's probably not the thing which has happened. And so if it's not the thing which has happened, the most logical solution for this would be that you've collected cash from customers. If you've collected cash from customers, that explains that 4,000. That's what you're trying to do all the time. Look at what you started with, look at what you've ended with, look at what explains that difference. So if we have, I'm going to do this one, I'll probably do one more just to kind of, I'm going to do this one and maybe one more, and just to sort of hammer home this point. But it's, what you'll actually see, it's the same process. You can use it with every single account and just go, what's changed? What do we know and how do we account for it? So calculating cash paid for inventory, we started with 290. Okay, so we inventory purchased during the year. So I'll get rid of this. All right, so let's change this. So we have assets inventory. Say we started with 10 and we're not even worried. Let's assume that we don't sell anything. Because if we sell stuff, that adds a layer of, okay, we've got to work out some other things. Let's assume we didn't sell anything. So we have 10 to start with. We have 300 to end with, which matches up with that information. So that's a balance sheet, you see that. You then see on the liabilities, accounts payable. And accounts payable has an increase. Let's say accounts payable goes from 25 to 33. That's it. That's all the information that we need. So if we see, we don't even need to know the cash balances for this. So if we started with $10 in inventory and we ended up with 300, what's the transaction? What would be the journal entry for that? So when you buy inventory, inventory is an asset, so that would be Filling up the, we've got sort of the usual crew kind of doing their thing. Anyone else want to offer an answer? By inventory, we debit what? Yeah, we debit inventory. So buy the inventory, debit inventory, and we can tell how much because it's the difference. So we buy inventory, debit inventory, and we credit. Well, let's assume we don't pay cash up front. You could, but then that gets us into a problem because if we paid all our inventory up front, then why have our accounts payable gone up? So let's assume that we owe these guys, that we get invoiced for it and we'll pay later. So we credit accounts payable, 290. So let's look at accounts payable. What you'll see is, and this is my preferred, and it's not just my preferred method of doing it. I've done so chartered accountants who are one of the professional bodies that you go through if you do one of their sort of professional qualifications. This is the way they get people to work through this stuff. It's called the reconstruction method. We're actually reconstructing what happened. So accounts payable started, is it a debit or credit? That 25 on this side or this side? It was a credit. I hope everyone was thinking, especially those who have been quiet, I hope you're all thinking it should have been a credit because it is. Starts at 25, ends at 33. That's what we know. That's not having to think about it. We would be told that information. And I know we got told it was an increase, but you could make it up as whatever increase you want. 25 to 33. Credit accounts payable gets added in. Does this plus this equal this? No. So we need something on that side to make that work out. The thing you have on that side, well, that would combine to become 315. So the difference between 315 and 33 is 282. So we would have debit account payable 282, credit something 282. What is the most logical thing that we would credit if we owe less to our suppliers? Cash. Is that the only possible thing that could happen? No. What could happen? Our suppliers could be really nice to us and say, you don't owe us any money anymore. They could forgive the debt. Now, that's not likely, but it's not beyond the bounds of possibility. But it's not the most logical thing that would happen. If you have your accounts payable, if you need something debited to accounts payable, so your accounts payable is dropping, the most likely thing is that you have repaid your suppliers. You've repaid them 282, that's what makes it work out. That's the 282. So you can actually do this with every single one. And this is the final one we will go through doing this. Because I know from talking to yesterday's class, like it's been a long, I know you guys have had, well, not every subject, but I've seen there have been assessments, there have been exams starting to start to happen. Is that true? Yes. Yeah, so there was exam timings on the board when I walked into the class yesterday. So, assessments are coming up, it's 5 weeks in, we haven't had a break. I think people are getting to the point where they need a week off, which is fine because next week is a week off. I just want to do one more and then sort of leave you with it. So cash flows, cash paid for operating expenses accrued, electricity expenses. So if we look at the information that we have up here, we have a payable. So we've got nothing here. We've just got electric payable or accounts payable, whatever it happens to be, and that has decreased by 200,000. So that's gone from, I don't know, 1.0 to 0.8, start end. and we've been told that our electricity expense in the profit and loss statement is 5.3. Now, if we're told our expense is 5.3 and we owe less, it means we paid more, because we kind of paid for what we had and then we paid a little bit more than that. So it makes sense it's going to be greater. You can certainly try to remember this stuff using the formula, and if that works for you, use it. But it's probably easy to think, well, electricity expense 5.3. If this has gone down, if this has gone from 1.0 to 0.8, and the electricity expense would be debit electricity expense 5.3 credit electricity payable 5.3, that would end up down here. That plus that doesn't equal that. That's 6.3. The difference between 6.3 and 0.8, 5.5. And so we'd have debit electricity payable 5.5, credit something 5.5. And the most obvious and the most logical thing that would be 5.5 cash. Just to leave you with analogies and sort of other ways to think about it. So last week, or when we talked about closing entries, and I talked about it's getting the game back to 0-all. The way I conceptualize this, and have done for a little while, is this is just literally problem solving, and you just feed in, okay, you know certain things. You know the start and the end, because you have the balance sheet. You know the start and the end. You know the start and the end. You have some other information. If you didn't have this, if this didn't happen at all and you had nothing about that, what happened? Tell me what happened if this is the only thing you know. So we paid electricity. How much have we paid? If this is the only thing, if this is the only information that we have, is that our payable has gone from 1 to 0.8. Yeah, that's it. That's the only thing you can say, because that's the only information you have. If you're then told what your expense is, then that changes what you know. So the way I like to think about this, and you may think it's a good thing or a bad thing, but as an accountant, when I go out, and I'm getting a bit older now, so I don't go out that often. But when I go out, how much I spend is usually a bit of a marker of how good a time I had. And I like to know how much I spend on it, when I go out. But you're not going to be sitting there at the bar, sort of tallying up how much each drink costs or how much each round costs, because that'd be a bit strange. So what I do before I leave the house, work out how much cash I got in my wallet, and I'll write that down and leave that at home. When I get home, I'll look at how much I've got left and go, okay, well, if I started with 100 and I ended up with 40, that's how much I actually came home with. I spent $60. That's the only thing I know. If I know the start point and I know the end point, I know how much I spent. So if I have no other information, I spent $60. And then I check my bank statement, and there was an ATM withdrawal for $200. I was like, okay, well, I've obviously spent more than $60. That's $260. And then I get my credit card statement, and so as more information feeds in, you get to adjust what you know about what happened. But at the very core of it is, if the only thing you know is the start and the end, you take that difference and that's what you spent. Take that difference, you paid your supplier $200,000. If you then find out your expense was 5.3, you've paid them 5.5 million. And you just add in information as you need it. I would highly recommend, as you're doing this, if you need to sort of work this stuff out, use T accounts. It helps you see really obviously where something doesn't balance. Again, you don't have to, I'm not forcing anyone to do, but I've used it a lot, and it helps in terms of mapping it all through. As to the rest of the stuff in here, you're actually doing the same. We don't go through this details in here, but for property, plant, and equipment, it's the same thing. What is your opening property, plant, and equipment? What's your closing property, plant, and equipment? If, as we did right at the top, if property, plant, and equipment increases and you get told nothing else, you bought property, plant, and equipment for cash. That's all you can work with. So it's the same process of setting this thing up and just working it through.